Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 380 on June the 20th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on BlackBerry, AT&T Inc., and Bank of America, and we discuss three new trades on TMC, the metals company, IREN Energy, now known as IREN Ltd., and Oscar Health Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the stock market finished about as close to unchanged as possible. The Dow Jones Industrial Average inched up 9 points, closing the week at 42,206 points. The S&P 500 index lost 9 points, ending the week at 5,967 points. And now it's time for the topic of the week. The topic of the week is journaling. Now, I'm not speaking specifically about a trading journal where you track your trades, your entry and exit prices, and possibly even your methodology for why you took the trade. This week's topic expands well beyond trading. Last week, I had a very full week, to say the least. I don't want to share all of the topics that were on my mind, but let's just say life gets interesting every now and then. I was on a flight back from New York City, and I had a lot of different things on my mind. I needed clarity, I needed peace, and I needed my mind to rest. Now, years ago, I remember reading one of Tim Ferriss's books where he mentioned the power of journaling. He said that it helped him calm what he called monkey brain, where your brain is just jumping from topic to topic without resolving anything. On that flight from the LaGuardia Airport back to DFW Airport, I pulled out my phone and I started journaling a bit. I wrote and I wrote and I wrote. Actually, I was typing, but you understand. Now, towards the end of all of that writing, I had clarity. I had some peace about what was next. This allowed my mind to rest as well. Now, I don't know why it took me so long to start journaling again. I knew what to do. I even knew how to do it. The best part about the journal is that I can go back and read it again and again. If I become anxious or feel that unrest on some of the topics again, I can return to the place where my mind found answers. Some people pay counselors lots of money to let them talk and listen and then help them find clarity in what they said. You can get a lot of the same benefits of therapy for the price of a notebook and a pen, or by turning to the notes section of your smartphone and starting to type. Now, I've never been good about journaling every day, but I just wanted to share with you all that journaling every now and then may be the answer to some of the challenges your mind is working on right now. So that's it for the topic of the week. As usual, we're going to dive right into the review of last week's trades. We start off with the covered call on BlackBerry, symbol B as in Bravo, B as in Bravo. At the time, the stock was trading for $4.08 per share. I looked at buying the July 4.5 call at 22 cents, hoping for a return of 15.69% in 5 weeks. Well, shares of BlackBerry grew 15 cents, ending the week at $4.23 per share. The call option that we sold grew 5 cents, leaving us with a net profit of 10 cents if we were to close the trade out immediately. Now, the stock price is still well above the break-even point, so there's no need to make any adjustments on the trade at this point. I'll definitely want to keep track of the stock over the next few weeks because this trade does have 4 more weeks left before expiration, but so far, so good on this one. Next up is the credit spread. We looked at AT&T Inc., symbol T as in Tango. At the time, the stock was trading for $28.16 per share. I looked at selling the July 28-27 put spread at 35 cents. That could give us a maximum possible loss of 65 cents per spread. Shares of AT&T fell 38 cents, ending the week at $27.78 per share. The out-of-the-money put spread that we sold is now at the money. The stock price is between our two strikes, And that means that the price has moved against us because we want this trade to expire with both of the strikes out of the money. Now, the stock price is still above our break-even point, which means this trade is not at a full loss yet. However, we're only 13 cents away from that happening. Now, my go-to move for offsetting a credit spread is to turn it into an iron condor. If you believe that the stock price is going to go higher again in the next 4 weeks, then you'll want to hold off on selling a call spread against this spread. I will hold off and not make any adjustments for now. I like to let the stock breathe a little bit before altering a trade. There's nothing worse than putting a trade on, altering it, and then watching the stock price move right back in the original direction that you hoped for, only to lead to a loss this time instead of a gain that would have come from a little bit of patience. So if you followed this show along for a while, you'll notice that I am much more patient in how I manage trades. That is just the result of a little bit more experience. Now let's get into the debit spread from last week. We looked at Bank of America, symbol B as in Bravo, A as in Alpha, C as in Charlie. At the time, the stock was trading for $44.09 per share. I looked at buying the July 44 call spread for 65 cents. That could give us a maximum gain of 35 cents, or that's a 53.85% return in 5 weeks. Now, shares of Bank of America grew $1.43, ending the week at $45.52 per share. The in-the-money call spread that we bought is even more in the money, and this trade is working out in a great way. Now, I'm going to discuss this one a little more than normal in response to an email I received from Don. Hey, Don, I will definitely email you back soon. Sorry, this week just got away from me a bit. Nonetheless, the question is what to do when a trade is working out in your favor like this. Now, our initial goal for this trade was to gain 35 cents on a capital outlay of 65 cents. Due to the amount of time that's left, I doubt you can capture a huge amount of profit by selling the same trade just yet, like closing the trade out. If you can buy the put spread with the same strikes, you could lock in a risk-free profit via trading the box. However, that put spread right now will cost 27 cents. You would lock in a whopping 7 cents on the trade. Now, that's a great return on capital, but a far cry from what's possible if the stock price remains above our strikes. You can also decide to try to capture more profit by expanding the trade to a $2 spread instead of a $1 spread. That also increases the risk of the trade if it moves against you, so I'm always really aware of that. Honestly, the number of possibilities for how we can manage risk on this trade will approach limitless, especially if you open up using other time periods as a hedge or rolling the trade. Now, as time goes on, if you can pay less than 35 cents for the 44 put, that also becomes a perfect hedge for the trade. So given the amount of time left in this trade, our options right now are not as appealing as they will be in the coming weeks if the stock remains above our strike prices, right? I am not leaning towards making any adjustment at this point, but if you wanted to lock in 10% return on capital, then the trade is worth closing. It all depends on your risk appetite and your capital goals. I always avoid giving people direct suggestions on the show because this is not a show where I give financial advice. I simply share how I'm looking at these trades and give you ideas of how a trader actually thinks about some of this, hopefully. The goal is always for you guys to understand individually and to learn individually, not to need a guru, if you will, or some random guy you don't even know giving you trade ideas every week that you're going to go off and blindly follow. So, Don, I didn't give you any financial advice or anyone else listening because I don't even know you. However, that's just how I look at this trade right now. So I truly do hope that helps. And I'll send you an email soon. All right, so that's it for the trade review of last week's trades. Today, June the 20th, was expiration for all monthly options in June. All new trades on today's show will use the July 18th expiration date for monthly options in July. All right, so let's dive in to our new trades for the week. We're going to start off with a covered call, looking at TMC, the metals company, symbol T as in Tango, M as in Mike, C as in Charlie. The stock ended the week at $6.56 per share. I'm looking at buying stock and selling that July 7 call at 70 cents. That could give us a return of 17.38% in 4 weeks. Now you enter this trade by buying stock for $6.56 per share and selling the July 7 call at 70 cents. This trade makes the most money if stock prices finish above $7 per share. The break-even price on this trade is $5.86 per share. In real terms, the stock purchase will require $656 and you'll collect $7 for selling the option. Next up, we have a credit spread on IREN Ltd, which has changed its name just to IREN. That's symbol I as in India, R as in Romeo, E as in Echo, N as in November. Stock ended the week at $10.47 per share. I'm looking at selling the July 10-9 put spread at 35 cents. That could give us a maximum possible loss of 65 cents per spread. Now you enter this trade by selling the July 10 put at 68 cents and concurrently buying the July 9 put for 33 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $10 per share. The break-even price on this trade is $9.65 per share. In real terms, you'll receive $35 per spread that you sell and have $65 at risk. And then our final trade on today's show is going to be a debit spread on Oscar Health, symbol O as in Oscar, S as in Sierra, C as in Charlie, R as in Romeo. The stock ended the week at $21.23 per share. I'm looking at buying the July 2021 call spread for 60 cents. That could give us a maximum gain of 40 cents, or that's a 66.67% return on capital in 4 weeks. Now you enter this trade by buying the July 20 call for $2.75 and concurrently selling the July 21 call at $2.15. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $21 per share. The break-even price is $20.60 per share. In real terms, you'll pay $60 to enter the spread, and your maximum gain is $40 per spread. So that's it for this week's show. Thank you guys, as always, for the emails. Thank you for listening to the show as well. Feel free to share it with friends that you know are learning options or just want to hear a couple of trades every week. And I really do appreciate when you guys reach out to me. Let me know what you're thinking. Let me know what you're up to. I always love to hear how long you have been actually trading as well. So that's it. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.